how you return back to the Lord is that you come out of your sin. That's part of repentance. You pray to the Lord, acknowledge the fact that you're in the midst of sin, and repent means to turn away from that sin. You understand that, brother? Now, are you willing to do that? If you are, okay, watch this. Give me Leviticus. What's going on, guys? It's Gabriel Israel. We're playing the Agape Rack. Hey, we here to do round 3. Let's see how we do on round 3. Financing a home purchase.
Welcome to round 3. In this round, we'll explore financing a home purchase.
You'll play a game where you'll help 3 guests and can earn up to 3,000 coins. To win this round, you'll need to earn all 3,000 coins. Hey Isaiah, I have a question. Why did the parents get such a tall house?
Why?
Because their children kept asking for more stories.
That's a good one, Kiara. Speaking of houses, let's find out about different types of home loans. For most people, buying a home requires a loan. Home loans are usually called mortgages. A mortgage is a loan that provides money to purchase a house, condominium, or townhouse, sometimes referred to as a row house. Depending on the kind of home you're buying, the loan may be called something else. For example, a loan for a manufactured home or mobile home is called a chattel loan. There are many costs associated with the loan to buy your home. The money you borrow from a lender to purchase your home, referred to as the principal, isn't provided for free. You have to pay it back plus additional costs. Our financial coach, Maxine, is here to explain. Select each of these 4 types of costs for more information.
Now, I have a question that I must ask you.
In addition to repaying the principal, you also have to pay interest. That's the money a lender charges for letting you use its money over time. It's expressed as a percentage. You may also want or need to pay points. Points are a way to lower the interest rate for the life of the loan by paying an upfront fee. Over time, this saves you money. 1 point equals 1% of the amount of the mortgage. For example, with a $100,000 mortgage, 1 point would be $1,000. By paying a point, the interest rate is reduced. You may have heard this called buying down your mortgage. For example, a lender might offer to lower your rate by 1/4 of 1% or 0.25% for each point you pay. Paying points can be a good choice for people who know they'll keep the loan for a long time. Lenders charge a variety of fees for processing your application. They may have different names, such as application fees, processing fees, and underwriting fees. Ask the lender what each fee is for. Try to negotiate lower fees. Remember, you can shop around. There may also be other charges, such as a charge for obtaining your credit reports or for an appraisal. An appraisal is a written document that shows an opinion of how much the home is worth.
You've selected each of the 4 types of mortgage costs. Select a type of cost to review it again, or select the Let's Play to move on.
Welcome to Zany Change. During this game, you'll get 10 chances to toss a coin on the game board, where it will land on either an exclamation mark or a question mark. If the coin lands on an exclamation mark, this sound will play. And one of our financial coaches will give you a tip about mortgages. If the coin lands on a question mark, this sound will play. And one of our guests will ask you a question. You'll earn 1,000 coins for each correct answer. Select the coin to begin. Lenders will tell you the annual percentage rate, or APR, for a mortgage you're considering. The APR represents the overall cost of the loan on an annual basis. The APR includes the interest rate, any points, some fees, and other charges that you have to pay to get the loan. The APR is usually higher than the interest rate. Looking at APRs is a good way to compare loans. We'll talk about comparing loans again in round 4. To continue, select the coin. The down payment is the portion of the purchase price of the home that you will pay upfront in cash. A down payment reduces the amount of money you need to borrow. Mortgages to purchase a home often require a down payment. However, the minimum amount required for the down payment can vary based on lender and loan program. And there are programs that can help home buyers pay their down payment. Many of these programs are designed for first-time home buyers. A first-time home buyer isn't necessarily someone who has never bought a house. It could mean someone who hasn't bought a house in a certain number of years. Be sure to explore assistance programs in your community. Let's look at an example. For a $160,000 home, you might pay $8,000 as a down payment. $160,000 minus $8,000 is $152,000. That means you would borrow $152,000. The $8,000 is a 5% down payment on the home. Why? $8,000 divided by $160,000 equals 0.05, which is 5%. The higher your down payment, the less money you have to borrow. To continue, select the coin.
Hi, I'm Samuel. I found a home I want to buy. I don't have a lot of money for a down payment. Can I still buy a home?
What should Samuel know about down payments? Is it A, there are loans with low or no down payment required? B, a 20% down payment is always required? Or C, a lower down payment means he has to borrow less money? That's correct. Samuel can shop around to find a loan that requires no or a low down payment. Plus, he may qualify for federal, state, or community programs to help pay the down payment. To continue, select the coin. When your down payment is less than 20% of the purchase price of the home, lenders might require you to purchase private mortgage insurance, or PMI. PMI lowers the risk to the lender of making a loan to you, and it increases your monthly payments because you have to pay the insurance premiums. PMI is different from homeowners insurance. PMI pays the lender if you fail to make the required payments on the mortgage. Homeowners insurance pays you for losses and damage to your property if something unexpected happens, like a fire or burglary. The terms of your loan will specify whether you need to pay PMI, how much it costs, and how long you have to pay it. To continue, select the coin. Hi, I'm Sasha. I'm shopping for a mortgage. What should I look for? What should Sasha know about shopping for a mortgage? Is it A, the interest rate is all that matters? B, paying private mortgage insurance will save her money on homeowners insurance? Or C, she should compare the APRs on different loan offers? That's correct. When shopping for a mortgage, Sasha should compare the APRs of several loan offers. The annual percentage rate represents the overall cost of the loan on an annual basis. It includes the interest rate and fees. To continue, select the coin. When you own a home, you usually need to pay real estate or property taxes and homeowners insurance. There are two common ways to pay these costs. You can pay them over time as part of your monthly housing payment. That's called paying them in escrow. Or you may be able to pay them yourself. Some loans require escrow payments. For other loans, you may be given a choice. If you pay taxes and insurance in escrow, your lender or mortgage servicer will let you know how much to pay each month, in addition to your mortgage payment. They will add these payments into an escrow account. Then, the lender or loan servicer will use the funds in that escrow account to pay your tax and insurance bills when they come due, typically once or twice per year. Your property taxes and homeowners insurance premiums can change from year to year. Your escrow payment, and with it your total monthly housing payment, will then also change. If taxes or premiums go up, your lender or loan servicer may give you the choice to pay the increase in one lump sum or spread it over your monthly payments. Even if you aren't required to use an escrow account, you may find it easier to have one, so you don't have to worry about separately paying taxes and insurance on time. To continue, select the coin.
Hello, I'm Jada. My mortgage payments are supposed to be the same each month. I have a fixed interest rate. Why did my lender notify me that my monthly payment is increasing by $46?
Is it A, Jada decided to pay for insurance herself? B, her property taxes or insurance premiums increased? Or C, the equity in her home increased? That's correct. Jada pays her taxes and insurance premiums in escrow. If the amount of either increases, she has to pay more money into escrow. Jada's monthly payments include the repayment of the principal plus interest on her mortgage. Her monthly payments also include payments into escrow. So, her total monthly payments may go up or down as the costs for taxes and insurance change. To continue, select the coin. Mortgages can be classified as either conventional or government guaranteed, which is sometimes called government insured. Anyone can apply for a conventional mortgage. However, it may be more difficult to qualify for a conventional mortgage than some other types of mortgages. To qualify for a conventional mortgage, you generally need a regular income and a credit history that a lender considers to be acceptable. You'll also need a debt-to-income ratio within the lender's acceptable limits, which traditionally has been 36% or less. However, there are exceptions. Don't get discouraged. Some lenders will approve loans for people with higher ratios. Usually, you also need to make a down payment. The amount required varies by loan type and lender. To find out more on the debt-to-income ratio, play round 2 of this game. To continue, select the coin. Government guaranteed loans may also be available to you. For those who are eligible, these loans are easier to qualify for and usually have better financing terms than what is available with a conventional loan. For example, there may be no down payment required or a low down payment. You may also pay less in closing costs. However, the exact details and requirements vary based on the type of government guaranteed loan. Government guaranteed loans include options from the U.S. Department of Agriculture, called USDA loans, U.S. Department of Veterans Affairs, called VA loans, and U.S. Federal Housing Administration, called FHA loans. There are also other types of loans from the U.S. Department of Housing and Urban Development, called HUD loans. Finally, states make additional options available through their housing finance agency or authority. To continue, select the coin. You may hear the term jumbo applied to mortgages. A jumbo loan is a mortgage for an amount above a certain dollar limit. A jumbo loan tends to be used for the purchase of relatively expensive homes or in high-cost areas. You may also hear the term second mortgage. A second mortgage is a loan you take out that will be in addition to a mortgage you already have on your home. Lenders typically consider second mortgages riskier than first mortgages because the lenders may not be paid back if you default on the loan. That's why second mortgages may be more costly than first mortgages. You've completed Zany Change. Let's go back to Isaiah and find out how you did in this round.
Congratulations! You earned enough coins to win this round. Remember, if you're logged in and playing to earn a certificate, you need to win every round.
Man, so hey, round 3, we got it done. Financing a home purchase. I hope you enjoyed. I hope you seen some things or learned some things that's going to help you to be able to give it to someone else. I mean, if it's something that you know, maybe it just was a refreshing course for you. But hope you enjoyed it. Hey, look forward to round 4. Like the video, subscribe to the channel, and visit our website. We'd like to say shalom.